When we think about the concept of taxing foreign residents, probably best to start with the concept that fundamentally no one really wants to pay tax. Most people and entities pay tax because they're obliged to. Thus, with entities and people outside of a jurisdiction, it's quite difficult to enforce this obligation. So while there are international agreements, you still must appreciate that each nation really wants the biggest share of tax revenue. And they come together to form these agreements, really to have some form of regulation, and also to some extent to encourage foreign investment within their borders. And so I think it's really important to start with this idea that in most jurisdictions, and Australia is no exception, this idea of asserting jurisdiction across taxable capital gains and income really is limited to things within your own borders. And so thus, when we're looking at the taxation of foreign residents, the systems that we have are some form of withholding. So you have withholding rules for Australian income which is paid, as well as capital gains that are made by non-residents. There's a couple of small things that you need to know about the use of withholding tax. The first is, in the simplest sense, it's a very blunt instrument. The purpose of withholding tax is to clip income which would go to non-residents that's paid from Australian sources. The systems and rules that we have for withholding tax, while in some situations can be quite complex, nonetheless, it's a very straightforward method for keeping certain amounts of income within Australia's borders. Another thing to note is that while non-residents are denied essentially the first two marginal rates, the tax-free threshold and the lowest marginal rate, they still pay tax at the remainder of the marginal rate structure in Australia. And the third thing that I want to note is that by and large, governments don't collect tax for other nations as a matter of public policy, but they can. And in certain situations with double tax agreements, that governments still can go through and collect tax and pay it offshore, but as a matter of policy, they rarely do so. One of the first, and I guess when explained, quite obvious points to make about taxing foreign residents is that they're still subject to the same rules of company tax and PAYG withholding as residents. People within Australia are going to be subject to. And because we have an imputation system with company tax, once tax is paid by the company, you would have a system of franking credits in order to send it to both residents and non-residents alike. But at the end of the day, the tax is already being paid. So in that aspect, nothing really changes in regards to taxing residents as opposed to non-residents. However, with things like bank interest, passive income, in that situation, we have withholding tax systems. You'll see the abbreviation WHT used throughout. A couple of other things to note. Firstly, banking, insurance, and shipping. Those industries have got specific rules for withholding, and that really falls outside the scope of this subject. Also note that business profits that are sourced from Australia are simply just going to be assessable income in themselves. One thing to note that under the general law, this principle of mutuality, the idea that you can't have income and or deductions in regards to yourself as an entity, that's one mechanism that stops foreign branches that are operating in Australia on behalf of foreign residents from obtaining essentially arbitrary deductions in regards to activities that they have in Australia. Also note that in situations where a foreign branch is operating inside Australia, the Commissioner of Taxation can actually make a determination in situations where those branches are actually operating as a separate entity. They can use arm's length principles to determine what actual deductions can arise. In earlier topics, we looked at the double taxation agreements, and generally these use the concept of permanent establishment as the basis of taxing particular types of business activity. This idea of a permanent establishment, or PE, has a statutory definition, but essentially it's a place that a person, entity, carries on a business. And it has this idea of both spatial and geographical notions, physical location and a minimum time. Usually that's 6 months. Now, under the PAYG system, normally salaries, wages, and such like are taxed, at least partially taxed at source. However, we do have systems under some of the double taxation agreements whereby foreign entities that have employees in Australia will not have PAYG deducted. For that to happen, usually these three things all need to be satisfied. They have to be in Australia for less than half the year. It has to be paid by the non-resident employer and not through a fixed or permanent establishment inside Australia. Section 255 of the 1936 Tax Act lays out some rules that make people liable for collection. And the starting principle is that people become liable to withhold tax that would be payable to a non-resident when either required by law or through situations where they're given notice by the commissioner. And in some situations, if the particular non-resident actually satisfies to the commissioner that the assessment that they're going to have to pay will be paid, or that sufficient amount of assets are going to be retained in Australia, the commissioner won't actually require that a person make the withholding. Thus, section 255 sub 1 sub a literally just states when the commissioner asks a person to withhold money that would be payable to a non-resident, they can be ordered to remit that money and essentially just give it to the tax office. And under 255 sub 1 sub b, a person is also liable to withhold money where a relevant statute says so. So in situations where money would become due, would become payable, the person is obliged to keep that money and not pay it when would otherwise be due to the non-resident. As you can imagine, some non-residents might be unhappy when some fraction of money that would otherwise be payable to them is withheld by people. And as such, the rules in section 255 actually provide a broad indemnification for people either obliged to withhold under legislation or upon being requested to by the commissioner. There's a couple of important things to note about withholding tax. The first is that it's an amount which is withheld from interest, dividends and royalties that would otherwise be paid to non-residents. Now, an important thing to note about withholding tax is that if it does apply to some or all of a particular distribution or amount that would otherwise be paid, that the amount that it applies to is going to be non-assessable, non-exempt income. In other words, it won't enter into the Australian tax system at all in regards to returns. So broadly, in terms of withholding tax, when we look at dividends, we're looking at the unfranked proportion of dividends. The reason for that is that in situations where we're paying franked dividends, tax has already been paid on that. And so that isn't something that withholding tax is going to apply to. Also note that different double taxation agreements have different amounts. And so mostly withholding tax is 15% for the unfranked portion of dividends from most treaty countries. Some it can be a little higher, so the US can be higher and Japan is a little lower. Note that there are a variety of exceptions that you can find in various double taxation agreements that we have. Generally, it's 10% for interest in most jurisdictions, a little higher in Malaysia, and in some situations lower in the UK and the USA. Royalties are split across jurisdictions, so 5% from a handful of nations: France, Japan, New Zealand, the UK, the USA. 10% for non-residents in China or Singapore, and most others, and 15% from those in Malaysia. In regards to non-DTA countries, in other words, jurisdictions that we don't have a double taxation agreement with, withholding tax is much higher. So it's 30% for the unfranked portion of dividends, 10% for interest, and 30% for royalties. So when is an entity required to actually withhold amounts? It's actually a pretty low bar, this test. So basically, if you have the person you'd be paying has an address outside Australia, and you have any record that that person has an address outside Australia, you're obliged to withhold tax. Or if you're authorized to pay that interest outside Australia, so that if you as the person paying are allowed to pay the interest to a place other than Australia, then you're obliged to withhold interest, withholding tax. In determining whether or not you need to withhold an amount when paying dividends, again, it's a pretty low bar. So as you would be aware, companies have a register of members or shareholders, and if that register has one of those owners that would be paid an amount has an address outside of Australia, then dividend withholding tax is going to apply. It'll also apply in a situation where the particular entity has directed or authorized to pay the dividend to an entity or to a place outside Australia as well. Note that withholding tax is only payable on the unfranked parts of a distribution. Again, the idea being that if you have a franked component, that tax has already been paid on that. So the exception to that exception is if there is some form of scheme. So you've got a system in place that are paying things in a certain way in order to obtain franking credit benefits. It's known as dividend streaming. It can also be a franking credit scheme under Part 4A as well. There is a small point to note that in a situation where you've got a resident company that's paying a non-resident, in a situation where it's paying, in particular, a non-resident parent company, and they're paying an amount that's been paid to it in the form of an unfranked distribution. Essentially, in situations where you're passing on a distribution that you would receive to your non-resident parent. In that situation, paying of the distribution will actually allow you to have a deduction. That's using the deduction method of preventing double taxation. And the reason for that is that the distribution that you've received is going to be income as part of that. So the two essentially are there just to balance each other out. Similarly to withholding tax for dividends and interest, the bar for an entity to determine whether or not they are required to withhold the tax for paying out royalties is also very, very low. So that if you are the payer and you have in your possession any record that has the recipients having an address outside of Australia, or not even that you've got in your possession, but kept or maintained on your behalf, and it's going to require you to pay the royalties with withholding tax. So that it's a really, really low bar. It's also going to be a situation where you're going to have to withhold tax when paying royalties if you are authorized to pay them to a place outside Australia. Again, this is expressed very, very broadly. As you can imagine with these things, the purpose of having withholding tax is really to cover the field as much as possible. There is a different obligation in situations where payment of income or capital gains is made in a situation other than royalties, interest, or through dividends. So basically, If a person carrying on their enterprise is going to make one of these payments, so they are the payer, and they have no reasonable grounds to believe the ultimate recipient of this income or capital gain is an Australian resident, and one of these three conditions is true. Either the recipient has an address outside Australia according to any record that the payer has or has access to, or the payer is authorised to pay this payment at a place outside Australia, or the payer has reasonable grounds to believe that the payee is a foreign resident. So if the first one, that having no reasonable grounds, is true, and one of those three limbs is true as well, then there is an obligation to withhold tax also. One of the really important trends in taxation law, particularly looking at international tax law, is the difficulty that jurisdictions have in preventing profits from being moved from jurisdiction to jurisdiction. And so this concept of base erosion and profit shifting is one which challenges lawmakers across jurisdictions, because there are some relatively straightforward mechanisms that entities that are able to operate across jurisdictions can use, generally to try and move profits from high tax jurisdictions such as Australia to low tax jurisdictions such as the Cayman or Panama Islands in the Channel Strait, for example. Now, the three that are listed here that we'll talk about, two of them we'll look in more depth, the third we'll just discuss now. Transfer pricing is the idea that where you have a subsidiary, you can sell and buy things from your subsidiary and parent company and manipulate the prices between those entities in order to maximize profit in the low tax jurisdiction and minimize it in the high tax jurisdiction. Then capitalisation is a system where you have or move a relatively large amount of debt from your parent entities in low tax jurisdictions to high tax jurisdictions so that you can receive debt deductions in those jurisdictions and pay the revenue to the low tax jurisdiction. Intangible asset rents is a situation where intangible assets such as brands or intellectual property are moved between jurisdictions in order for amounts to have to be paid and claimed as deduction in high tax jurisdictions, with those amounts appearing as revenue in low tax jurisdictions. One of the key things about transfer pricing and why it's difficult as a system to try and really stop through systems of anti-avoidance is because transfer pricing fundamentally involves legitimate businesses. Say, for example, a car manufacturer may be selling cars in a high tax jurisdiction such as Australia, and some fraction of those cars will be manufactured in some lower tax jurisdictions, and raw materials may come from other jurisdictions as well. And so by having and controlling all aspects of the supply chain, it means that where some particular parts of this manufacturing process are in a high tax jurisdiction, those entities can be overcharged, whereas you can undercharge entities forming part of this value chain where they reside in low tax jurisdictions. So really it forms a mechanism for profit shifting while shrouding it inside a collection of legitimate business activities. Put simply, the absolute key aspect of trying to prevent transfer pricing and having systems that sort of stop this arbitrary movement of profits between jurisdictions with different tax amounts is what we call the arm's length principle. That is the basis of our regulation and the statutory mechanisms we use going to look at the underlying substance of transactions and compare those with what would have happened if the parties were acting at arm's length with each other. So how's this enshrined in Australian law? Well, the arm's length principle is set in the new Tax Act in Division 815B. And it says simply that where an entity would otherwise get some form of tax advantage that we call a transfer pricing benefit in Australia from some conditions that go across jurisdictions that are inconsistent with internationally accepted arm's length principles, then those transactions need to be recalculated in accordance with those arm's length principles. More specifically, these transfer price benefits happen when the entity's taxable income would be greater than it actually has been, or the loss would be less, or the tax offset would be less, or withholding tax payable in respect to interest or royalties by the entity would be greater. So if any of those occur, it's going to be deemed a transfer pricing benefit. What happens if an entity receives a transfer pricing benefit? Well, the legislation says that the entity has to substitute the arm's length conditions and basically in place of what actually happened. So this idea of substituting the arm's length conditions is basically the mechanism that the legislation uses to remedy this particular transfer pricing benefit problem. The technical way of expressing these arm's length conditions is that both the ATO and ultimately the court, they looked at both the form and the substance of the underlying relations between the entities. And so they look at those and they basically examine whether or not entities that were wholly independent of each other would have entered into these relationships or not. The key phrase that they use is this comparable circumstances. In other words, if there was a situation where you've got an entity, the test entity, and the related entity that's having the transactions or arrangements with it, they look at what would this abstract independent pair of entities do in comparable circumstances. And while there is a non-exhaustive list, some of the factors that the commissioner and or the court can look at is the functions performed or the assets used and the risks that are undertaken by the entity, the characteristics of particular property and services that are transferred, the terms of contracts that operate between the two entities, any surrounding economic circumstances, as well as the underlying strategies and goals of the entities themselves. So the courts will look at a variety of factors to try and determine whether or not in this situation, again, the test situation, is one that would have also have been dealt with the same if the parties were in arm's length. I guess a subset of the transfer pricing rules involve permanent establishments. And so with permanent establishments, rather than have this abstract concept, we have a very concrete one. Basically, they determine what would the actual profits of a particular entity be if this permanent establishment were a distinct and separate entity onto itself. So they look at the activities and circumstances of it, including the various functions and risks that are borne by that permanent establishment, and the conditions that operated between that separate entity, in other words, the test entity, and the entity that this permanent establishment would have been if this arm's length condition had applied. So really this is the test that you're going to have, and how it's much more tangible than the abstract rules for transfer pricing in situations where you've got a permanent establishment. You can note here that the transfer pricing rules also apply to trusts and to partnership, essentially in the same way that they apply to companies. using the arm's length principle. Note that trusts don't have losses, and whereas partnerships do, and those can be again examined by using the arm's length principle also. Another thing to note are the substantiation requirements for transfer pricing. Look, the entities are required to maintain and keep and update a series of records in regards to multinational arrangements that could have transfer pricing implications. And if they fail to do that, that relevant entity can't argue the reasonably arguable position, or the REP, in order to try and get any administrative penalties reduced or waived. And note that this is expressed in quite broad terms. So a person carrying on a business has to be able to explain their actions and various transactions. And as part of both of those things, they have to explain how things operate in regards to related entities where you're buying and selling services or having arrangements between them for the purposes of transfer pricing. A much more onerous set of obligations applies where the global annual income of an entity or a collection of entities is more than $1 billion. And so the ATO, it basically has a lot of powers, and they really have a dialogue with these entities, because those entities have to require, they're required to have and supply a very large amount of data detailing transactions that go between various corporate entities in these groups. And so those master files are presented to the ATO periodically, and those things are used to really map and model how the transfer pricing is going to operate between those large entities. So just if this does come up, note that while the rules at the starting point are going to be the same, the reporting requirements are vastly more stringent. So in regards to assessment for transfer pricing, fundamentally this is a self-assessment process. So taxpayers are required to, when they're doing their returns, actually calculate whether or not they've received a transfer pricing benefit or not. And the ATO, really to try and increase the compliance with this area of law, have a system whereby taxpayers and their advisors can again enter into a dialogue with the ATO staff. They can talk to them, about their arrangements, and reach some form of agreement as to how the methods that they're going to use for applying this arm's length principle are going to apply. And they can do that on this prospectus basis. So map this out with the tax office ahead of time in order to really make it a little bit more cooperative, rather than after the fact going in and trying to analyze those things, which can end up being very adversarial. We're going to look now at thin capitalization. And fundamentally, this is the ability of entities that operate across jurisdictions to be able to manipulate debt deductions. So fundamentally, the whole purpose of the thin capitalization regime is to try and allocate tax deductions for debt appropriately. Because prior to these sorts of rules coming in and actually being used to try and prevent this from happening, entities were quite readily able to move large amounts from low tax jurisdictions into high tax jurisdictions such as Australia. The idea being that if you lend your Australian subsidiary a whole host of money, sometimes that they don't need, then that amount, the debt, the interest that is payable on that, is a deduction in Australia. And so that meant that you could artificially move money around through your variety of corporate related entities, move them into Australia, and have these highly leveraged Australian entities able to claim large amounts of debt deductions in order to minimize their assessable income. Now, when we're looking at the thin cap rules, just note that this the rules apply slightly differently for what we call inward as opposed to outward investing entities. Also note that there are separate rules for ADIs for banks as well as for financial non-ADIs. Is a relatively recent change where entities that fell short of banks but nonetheless had their own quite unique requirements for leverage are now mapped out in a slightly separate regime and system. So in this particular part of this topic, we're really going to look at the general purpose entities, both inward and outward, rather than focusing on the banks or the financial entities. Now, the definition of outward as opposed to inward investing entities really flows from the name. The idea being that if you have an Australian entity that owns foreign entities or carries on a business through a permanent establishment overseas, including branches, or is associated with those types of entities, that's going to be an outward investing entity. And so some parts of the thin cap rules will look at the OIEs, or outward investing entities, because while the two can be distinct, it's actually quite common that they are both as well. So an inward investing entity is an Australian entity which is controlled by a foreign entity, or a foreign entity that has an Australian permanent establishment or some mechanism of direct investment in Australia. And so these outward entities are those that are Australian, that go outwards and own or run businesses in foreign jurisdictions, as opposed to inward investing entities, which are Australian entities that are controlled by foreign entities, or those entities are somehow deriving income through investments here. The fundamental remedy that arises with these thin capitalization rules is the disallowing of debt deductions, because the purpose of this whole system to prevent avoidance of tax is to do with debt deductions. And so what we do as part of this process is to calculate what the maximum allowable debt of an entity is. And so once we've calculated that, then we can work out, of all of the debt that's actually allowed, what is the amount of deductions for debt that we are going to disallow. So that entire process of calculating the amount that's maximum allowable debt is really to try and determine what amount is this entity allowed to have in order to really obtain a deduction. Beyond a certain point, they won't be able to claim a tax deduction. So regardless of whether we're looking at an inward investing entity or an outward investing entity, we're trying to calculate what this maximum allowable debt is going to be. And the rules for each of the two entity types are going to be slightly different in terms of the calculations. And so for inward investing entities, this maximum allowable debt is the greater of these three things: what we call the safe harbor debt amount, or the arm's length debt amount, or the worldwide gearing debt amount. That third one, we can only examine that if these three things don't apply. So we can use the worldwide gearing amount unless any of the following things apply. And those three things are: this entity statement's worldwide equity or statement worldwide assets is nil or negative, or the audited consolidated financial statements don't exist, or the average Australian assets of the entity divided by this statement worldwide assets of the entity for the income year is greater than 0.5. So that if any of those three things exist or are true, that you can't look at the worldwide gearing amount when you're trying to determine the maximum allowable debt for inward investing entities. For outward investing entities, it's a little simpler. So it's the greatest of these amounts, either the safe harbor debt amount or the arm's length debt amount or this worldwide gearing debt amount. There's no disclaimer that prevents you from using that third one. This rule for calculating the safe harbor amount for inward investing entities is interesting for a couple of things. One is that it's a slightly different style to what you may have been used to when you're undertaking both tax and other areas of law. Why is that? Is that it, rather than mapping out some rules, it maps out a series of steps for calculation. Now, you'll note that there are quite a lot of them. I'm not going to read through them here, but it's essentially a series of steps that you take in order to calculate this safe harbor debt amount for this type of entity. Also note that some of the amount, so amount that's been calculated at a certain step, can be used in some of the other calculations and rules later on. So the reason why it's expressed the way that it is, and I guess it's kind of important when you are doing these calculations that you do step through each of those steps in order to reach your calculation at the end, and keep note of the amounts at each step, because some of those things will be reused later on. Similarly, with outward investment entities, there are a series of steps, and again, there are certain points in this method where the numbers that you have in your calculations are used for other parts of other tests. Also note that for the purposes of this subject, that the numbers you'll be given will be simple. So numbers that you ought to be capable of doing and calculating in your head. You won't be given complex series of numbers or values. So unlike the quite methodical series of steps that we use for the safe harbor amount, this arm's length debt amount is simply a notional amount. So it's basically what would the entity have reasonably been expected to have if there was a situation where a commercial lender that wasn't associated with this entity would have entered into. So what would have happened if this money was lent by an actual commercial lender, so an independent third party? That's going to be the amount we're trying to assess in terms of this particular step in the process, this arm's length debt amount. Now turning to this worldwide gearing debt amount, in the first case for inward investing entities. Again, we've got a series of steps. So we've got 5 steps here. And note that step 4 actually requires us to go back and look at step 4 of the safe harbor amount. So as noted before, that when you are going through and calculating each of these steps, it's important to just make note of where you're at as part of this. Being careful with how you do these calculations is really the key to being successful in this part. For the outward investing entity worldwide gearing debt amount, again, we've got a series of steps. Again, there is a reference back to the safe harbor calculation amount from step 6 in that series of calculations. Also note that the way this is expressed in the legislation, while occasionally they will add steps, so in this case we don't have one, when they add a step, they'll call it step 3, capital A, capital B, and so on, to insert steps. But when they remove steps, they just leave a note stating that that particular step's been repealed as part of that process. And so sometimes it looks a little odd when you're going through and reading an actual piece of legislation with a series of steps where it'll just refer to particular items that have been repealed. And so again, I reiterate, the key thing is with these, just be methodical and be careful about mapping out which step you're at in terms of doing that these calculations. Now, once you've calculated this maximum allowable debt, you then need to determine what the actual amount of debt was present in this entity. And that difference is the excess. And once we've calculated this maximum amount, we're then just going to essentially multiply that by a fraction. So this excess debt divided by the average debt over the period, multiplied by the amount of deductions, so the amount of debt deductions that the entity would otherwise have claimed. That's going to be the amount which is going to be disallowed in this particular period. Finally, we're going to look at some situations where an entity doesn't need to do any of these thin capitalization calculations. So the first one seems pretty straightforward. If you aren't having any debt deductions, you don't need to do any thin capitalization calculations. Secondly, there's a de minimis rule, which is where an entity whose debt deductions, again, including all associates, are $1 million or less. So when we say de minimis, it's actually quite a large amount. The purpose of the thin capitalization rules is really aimed at larger entities. Thirdly, an Australian resident that's not an inward investing entity or an outward investing entity. So that if it doesn't satisfy either of those tests, then the thin cap rules won't apply. A foreign entity that has no presence in Australia is also going to be an exception. And an outward investing entity that's not also foreign controlled and has a small amount of overseas investments. So that is when foreign assets of the entity and associates is 10% or less of the combined Australian and foreign assets. So in that situation where you've got, said, an only place for OIEs that isn't foreign controlled and has only a small amount overseas, in that situation they won't be required to do any of the thin capitalization calculations either.